What's going on, everybody? Michael Silva here. Yes, the whole world is talking about this head and shoulders topping pattern, but where are the sellers actually hiding out? Well, we're going to talk about that on today's stock market brief show. Yes, because these head and shoulder patterns, as easy that as they are to just point out, hey, here's the top of the head, here's the neckline. If you measure it down, the full measured move would take us to the same distance from the neckline down. That would be around 410 into this prior cluster. As easy that is to say, it's a lot harder to just put on a position and trade. So in today's video, we are going to be diving into more key specific levels. We're going to be looking at weekly expected moves, daily expected moves. We're going to look at some of these anchored VWAPs that you see on the screen. We're also going to get into some gamma exposure levels and the market decks as well. We're going to start off looking at the 11 sectors that make up the SP 500. Everything today was in the green other than one, utilities, which is a more risk-off type asset, and you can see that that was rather flat on the day. And the S&P 500 was up slightly, about 0.63%, the same as the Dow. The Nasdaq was up a little bit higher, and you can see over here small caps were up a little bit higher than that. If we take a look at what the volume looked like though on the S&P 500, you can see it was a pretty low volume, lackluster type day, kind of just drifted up higher, as you can see from the price action. And this could be because, well, we have some macro data coming out, and the market might be just paused until we get more information, and that might be when the volume really starts to step into play. Now, I want to call out a couple of key levels here on the daily time frame, and these levels are based off of what's known as the volume-weighted average price, the VWAP, but these ones are anchored to specific periods in time. The time that we're using is the quarter to date, the month to date, and then also this top over here on the high of 2023. Now, the reason why I like the quarter to date and month to date, you've probably heard the saying like quarter to date or quarter end markup, right? This is where investment firms, they reposition themselves, getting ready for the new quarter. And even same with month to date, you probably hear like month end markup. There's typically a lot of volume traded on these days as the markets start to reposition themselves into a new quarter and into a new month. So I like to always position an anchor there because it quickly tells me, hey, if price is above the quarter to date anchored VWAP, that means the average buyer based off of volume in that time is in the green. So sentiment should be fairly bullish. And if it's below it, well, sentiment would be fairly bearish. And you can see the quarter date right here, we were below it, so we say be careful. When it got above, we said, okay, more bullish. Okay, well, it came all the way up here, and then price action got below it, and what did we say? Okay, well, be more bearish, right? And this is where we saw that big sell-off. But you can also see price action up here did something specifically called a bearish engulfing candle. This tells us, it could be a turning point in the markets. It shows us that, buyers bid the market up. We opened the day up a lot higher, but we closed on about the lows of the day, engulfing the prior trading day candle. And that right there is it could be a potentially very bearish turning point in the markets. And if you want to know more specifically about that on this day, you can go back to my video where I recorded on this specific day and talked about the possible turning point and how that it was such an authoritative candle, it's likely to see a potential bounce, but if we don't get above this high, it's still a valid potential turning point. So we bounced, and this is where the sell-off occurred. Okay, over here, what you'll see is another bearish engulfing candle, quite a big one, where we gapped up into the month-to-day anchored VWAP that held as resistance, and we closed at the low of day. And what you're seeing here is actually a current bounce. So it would be nice to know where potential sellers might be hiding out. And you could do this by, like I said, the month-to-date, quarter-to-date, and the topping point right here. We're below this, so there's a red zone. This red zone right here can be a potential level of confluence of resistance, but there's actually more levels that are going on within this area this specific week to be aware of if price were to reach into those levels, okay? And I'll show you those levels by using SPY gamma exposure. This is really just, I guess, in short, it's an indicator that tells us the action of a lot of traders, right? And how much position from the market makers is not yet hedged. Now, I'm looking at spot GEX. It's just a different way of viewing GEX. That's all it is. And basically where price is right here, where these gray bars are, if we move into a green bar, right, as we're moving to it, as dealers hedge, when it's a green bar, it would just say that, hey, they could assist with that move in buying, okay? But if we move into a red bar, that could be where selling occurs or potential resistance takes place. So I applied these to a chart just to show you the key gamma exposure levels on the SPY on the daily time frame. What you'll notice here is price is kind of pinned right between two red levels. So if price wants to continue to press up and move through this kind of zone here, 446 would be the key level to watch as a potential level of resistance. And that actually is in confluence with, well, 446, the quarter to date anchored VWAP, right around the topping anchored VWAP, and just above, just below, or that would be just above the month to date anchored VWAP. So there's a lot of confluence in that area. So that would be the level in the short term to potentially watch for overhead resistance. And where could more selling take place? Well, this level right here, this gamma exposure level is right here on the chart, and this is a larger level. So if price breaks through this, look at this as a potential level of resistance, and if we can't get back above it, you might be coming in where sellers, right, selling starts amping up a little bit into the next gamma level, and the next gamma level would be where that neckline is, okay? And those are two big levels. So from this perspective, looking at gamma exposure, the upside, right? So if I'm looking at this from risk to reward, the reward for going long could be up into 446, okay? But then the downside could be all the way down to around that neckline. So obviously, as the market's moving down, it could be much more bearish. However, in the shorter term, I would just pay attention to the low of today's trading day. If we were to break down through that, then as long as this holds as resistance, it opens the door for more selling to take place into this next gamma level. Now, if price can hold above 446 and get above it, well, guess what? This can open the door to hit that 450 level. And if we can do that and price doodles around in this area, well, this could assist with the move more further to the upside. Now, if I look at daily expected moves today, right? So if you don't know what a daily expected move is, this is the options market are pricing in these expected moves. It's forward-looking risk. So coming into Monday, we knew this level out of the gate. Coming into Monday, we knew this level out of the date. Coming into the week, we know this level and this level. This is what the market's pricing in. And if you think of this in terms as a distribution curve, right, 68% of the time, it's going to close within one standard deviation. So 68% of the time, it's going to close within this. And then a two standard deviation would be 95% of the time, it's going to close within this range for the day. Same thing with the week. The week of the orange lines, it's telling us that 68% of the time it's going to close for the week between 433 and 446. I'm rounding. You can see what happened. Well, we came in, we started the day at the daily expected move. And then guess what? Sellers stepped in and pushed price down. We moved back up into it, push it back down. We moved back into it, and boom, we closed right at that level. So that was a very clean, nothing unexpected from the market on today's trading day. So what are the new levels to watch out for? Now, before we get into the new levels, I want to show you the market DEX. And the DEX is another tool that is this daily sum of deltas from the options flow across the entire market. And when you look at this, basically it's just saying, hey, if it's green, okay, well, there's more of a bullish bias going into tomorrow. If it's red, there's more of a bearish bias going into tomorrow. Just very simplistic terms. And right now, like the prior day, we had a green bar, and today was up slightly. Well, and this doesn't hit all the time, but you would want technically a more bullish bias going into tomorrow's trading day. So with that said, if I update you on the new daily expected moves, what are we looking at? Well, I want to start by looking at the 5-day moving average, because this is one that I use as just a trend indicator, and I want to follow the trend. And price is above it, and it's starting to incline, okay? Yeah, it's rather neutral as far as price action goes, but it is starting to turn up, which is a bullish sign, and price action is above it. So guess what? You actually technically have a more bullish bias here, okay? So that's a positive sign. Now, does that mean I just enter here and then hope it comes here? I mean, if that's your strategy, fine. But what if price breaks down from the week-to-date anchored VWAP and it starts heading back down to the 5-day moving average that's currently inclining? You can look at the lower daily expected move at 440.20. Now, do you remember 440.20, what level that actually is? Well, if you do, it's right here. That's actually the low of the trading day today. So when I look at this from a perspective, 440.20 is the lower daily expected move. 68% of the time it fits in here. If we start getting outside of it and it holds as a level of resistance, that is when dynamic hedging takes place and more selling could amplify. So selling into more selling, and it pushes price down further. So as long as we're above 440 tomorrow, it'd be more a bullish bias, right? As this starts moving up, even if price were to come down here and it just doodles around it, maybe base conform, and then we could start seeing a stronger move to the upside. That's a possibility, but you never know. Price might just doodle around, flag out a little bit longer, and then potentially we might break out and try to reclaim the month-to-date anchored VWAP. You can see here on that bearish engulfing day, price came up and then we sold off heavy into this area, and we're not too far off of that level, okay? So what if we get a strong move and it pushes up to this level? Well, the weekly expected move is 446.72. That number should sound somewhat familiar because there is a gamma exposure level there, okay? Not only the gamma exposure level, right? Options market priced this in at the close of business on last week's Friday, right? So these levels were brought to, we pulled these levels on the weekend, and so 446.72 would be the upper weekly expected move, and just so happens that last weekly upper expected move is right here, and this is also where price got kind of hit back down. Okay, so if I'm looking at this, if I'm looking over here at 446.72, that's also in confluence with the quarter-to-date anchored VWAP, which we priorly discussed overall there as well, okay? So if I'm looking at this from a shorter-term perspective, and I'm saying, okay, right as of now, we're above a 5-day moving average, it's starting to incline. Okay, cool. I'm bullish, but I want to see price action, how it forms to potentially play a move back up into the month-to-day anchor VWAP and potentially the daily expected move. That would be the trade idea. However, when we start getting below this 440 level, I'd proceed with caution and let a price action kind of resolve itself, because if it wants to start getting below it and the 5-day starts moving back down, this would still be in the decline phase, all right? Remember, the market structure moves between 4 different stages: accumulation, markup, distribution, decline, and then back to accumulation. Okay? And the way that we look at this from the shorter time frame, I can use the 5-day moving average, where we're in a stage 4 decline. This could be potentially a stage 1, and we could be at the early stages of this turning up to a stage 2 markup, and then we look once again to see if price action neutralizes and goes flat to potentially declines again. So today's episode, I talked about a lot of different key supportive levels and got a little bit more into detail about, more key levels than just saying, hey, here's a neckline, breaks down to 410, and that's it. So hopefully that helped out. That's all I got for you on today's episode, everybody. See you later.